Good afternoon. A very warm welcome to everyone. Thank you for joining Corporate Connect. I'm Eileen and I'm your host for today. This afternoon, we're pleased to invite Uni-Asia Group as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Mr. Jeff Howie, Market Strategist from SGX Group, on recent market highlights, followed by a corporate presentation by Mr. Lim Kai Ching, Group Chief Financial Officer, Uni-Asia Group, and we will end off today's Q&A. Uni-Asia Group and its subsidiaries is an alternative investment group specializing in creative alternative investment opportunities and providing integrated services relating to such investment. The group's alternative investment targets are mainly handy dry bulk ships and properties. This afternoon, the company will give us an update on their FY 2020. But before this, let's invite Mr. Jeff Howie to give us an overview on how the market performs. Over to you, Jeff.
Thanks so much, Eileen. I'll just share the screen. Bear with me, please. Okay, great. All right, thank you very much. Just a very quick educational overview that won't take any longer than 10 minutes, just in terms of, I guess, a monthly wrap for the end of April. So after ranking as Asia's strongest benchmark last year, our SDI is placed more in the middle of the leaderboard so far this year. We've had measured moves across the region, very much tied to economic developments. But nevertheless, the Singapore benchmark SDI still maintains a lead on the FTSE APAC and the FTSE ASEAN All-Share Index since the end of 2019, with a 16% total return versus a 3% gain, as you can see in the chart, for FTSE APAC and a more flat return for FTSE ASEAN. I guess we're more in a longer game now with US inflation, which is seeing the tempo of market reactions to this to the data that comes out slow down somewhat, to the point that last month's comparatively narrow trading range for 10-year yields saw the STI, which is 45% banks, which in turn are 65% net interest income, saw the STI generate its narrowest monthly percentage trading range since February of 2015. I guess some of the good news is that for house research here in Singapore, we are seeing more differentiation in individual stock performances within the sectors. That has been emerging, and that does set the stage for more bottom-up investing as compared to the dominance of top-down investing in the recently heavily driven macro years. Banks have commanded a high share in local trading turnover as well. Last year and in the beginning of this year. This could moderate though as the year progresses, because we have seen that with the focus on the FOMC nearing its pause or its peak rate with these smaller rate hikes, the day-to-day swings of the trio have been moderating. So weekly amplitude or percentage ranges, if you will, for the high to low for DBS have been around 3.4% so far this year versus 3.7% last year, down 1/10 as well for OCBC, and down around 0.2% for UOB as well. So I guess the market is also explaining some of the more slower moving market is that the market has not been this certain on a 14th of June FOMC decision. It hasn't been this certain on a FOMC decision 5-6 weeks out from an FOMC since this rate hike cycle began, with around 100% expectations for a rate pause, which was signaled by the Fed chair. And while the Fed chair did signal the pause was imminent, he could not signal cuts, nor could he afford to signal a peak, as the persistent aspect of the US inflation gauges does remain a key concern. The US PCE core deflator has been range bound between 4.3% and 5.3% for the past 18 months, and it did come in at 4.6% for March. So unlike the emerging markets around the region, which have their inflation more linked to goods, inflation in the US is more linked to services, and in particular wages. So For the trio of our banks here in Singapore, the net interest margins, they are expected to consolidate on a quarter-on-quarter basis after we've had these, as you can see in this histogram chart, 9 consecutive quarters of combined quarter-on-quarter net interest income growth. The net interest margins, along with loan growth, do drive the net interest income of the banks, which in turn, as we said, makes up 2/3 of their total income. Loan growth guidance for DBS is at 3 to 5% for this year. UOB is also at a low to mid-single-digit percentage guidance for loan growth for this year as well. And back in Feb, OCBC, which reports tomorrow morning, did flag mid-single-digit loan growth for 2023 as well. So we'll get their latest guidance before the open tomorrow. On the non-income interest front, the non-interest income front, the DBS is expected to see double-digit fee growth this year, and UOB also expects high single-digit fee growth. And both banks, of course, maintain the same NPL ratios as they did at the end of the fourth quarter. One small development, I guess, since then is the impact on the CET1 ratio for DBS after the additional provisions were placed on it last week. It means that the CET1 ratio for Common Equity Tier 1 ratio for DBS has come down slightly from 14.4% to 14.1%, which is still above its target range of 12.5% to 13.5%. So it still maintains it has adequate cash to maintain its dividend payouts. But all eyes will be on what OCBC have to say tomorrow morning, and then we'll have the combined results of the three, which I'll touch on next week. But of the 5 macro themes this year, which include growth, inflation, rates, geopolitics, and financial stability, the latter two do, I guess, maintain the highest level of uncertainty. That's geopolitics and financial stability. March did see a snap increase in trading and hedging activities across Singapore's financial sector, and that nudge to global financial stability we saw in March, it was of course circumvented by the action of the 6 central banks after the 19th of March. And the FOMC minutes back in March did show that it was US regional banks with unusually large reliance on uninsured deposits and holdings of securities with significant unrealized mark-to-market losses that really had experienced the bigger declines in stock prices. So this I guess fracturing or fragmenting of the bank sector, you can see it in terms of the average declines in total return of the STI banks, which is around 2% as of the close on Friday, compared to a 9% decline for the Dow Jones Large Cap Bank Index, which is made up of 7 banks. You've got a 26% decline for the S&P 500 Select Industry Index, which is made up of 95 stocks. And then you've got a decline of 36% year to date for the S&P Select Regional Banks Index, which is made up of some 140 stocks. So much focus in the US is on commercial services and the commercial side of the US economy, which is mostly counterparty to the smaller banks. The sustainable solutions theme I should mention too, it has been a key highlight for the STI so far this year, with both Keppel Corp and Sembcorp Industries leading the STI so far this year. Keppel Corp is establishing itself as a leader in energy and environmental infrastructure and services as well, and its renewable energy portfolio has grown from it's grown to about 2.8 gigawatts at the end of March, which was up from 2.6 gigawatts at the end of last year. Sembcorp Industries also maintained 8.3 gigawatts of gross installed renewable capacity, and it's targeting a 10 gigawatt capacity by the end of 2025. So what this means is that unlike conventional energy, renewable energy, it's not baseload and does not generate electricity 24/7. So the power generation really depends on the plant load factor of the renewable energy assets, such as irradiance levels for solar, or the wind resource is the measure for wind assets. So for its solar assets in Singapore, if the plant load factor, say, was between 13–15% thereabouts last year, and assuming S&P Group HDB flat average consumption, then 1 gigawatt of power could theoretically power over 270,000 four-room HDB flats in a year. So there's just a kind of an example of how those gigawatts do have an impact economically. I should just also follow up quickly on REITs. Still watched more than any other segment by retail investors in Singapore. In the example that 3 of our 4 most opened weekly My Gateway newsletters this year have been focused on S-REITs, and that's also coincided with around 140 million net retail inflow booked for the sector for the first 4 months of the year, and the popularity of the REIT of the BT REIT Watch column as well. So S-REIT sector is highly diversified. You've got industrial REITs, the strongest sub-segment so far this year, on positive rental reversions versus the hospitality trusts, which we saw outperform last year. REITs with lower gearing ratios have generally been observed to be more defensive over the past 18 months when you look across the broad spectrum of them. But investor attention, it has not been all about banks and REITs. As much as 20 cents in the dollar has gone to work in Singapore stocks this year that are involved in the manufacturing related businesses. And this genre of stock, it's known to be very forward looking. Singapore is based over 100 of these type of stocks. They have relevance across all 6 clusters of our industrial production here in Singapore. And the lion's share of these 100 stocks also maintain international revenue streams. So interesting too, while the broader Singapore stock market saw around 1.9 billion Sing dollars of net institutional outflow in the first 4 months of the year, combine these 100 plus manufacturing related stocks book net institutional inflows so far this year. Okay, so I'll probably, now's a good time to finish off, Eileen, and let Uni-Asia have the stage. But any more interest on what we're seeing in the market or relevance across these sectors, please feel free to contact us, which you can through this QR code. Thanks so much.
Okay, Jing, you may start your presentation now.
Oh, okay, sure. Thanks.
Thank you.
Good afternoon, everybody. Just to make sure everybody can see the slides. I'm from Uni-Asia. Today we're going to go through a bit about our company. My name is Lim Kai Ching. I'm the Group CFO of Uni-Asia. We are listed on SGX actually on 2007. So we have been on SGX main board since for 26 years. And we have offices in Hong Kong, Tokyo, as well as Singapore. We have a ship management company in Shanghai and a small company in Guangzhou. Now, Uni-Asia, we have investments in vessels as well as properties. And the question always why do we do ships and properties? So basically our business models are to acquire assets at competitive prices, mainly ships and properties. And we provide client solution relating to such assets. Thereafter, we manage and operate such assets in order to derive capital returns, recurring income, as well as ad hoc income. Now, in terms of our business segments, we segregate them into 2 main categories, shipping and property. And in terms of shipping, we further segregate them into ship owning and chartering, where we have 10 wholly owned vessels, maritime asset management, where we have joint venture structures of our vessels, and also maritime asset management provides arrangement fee services to our clients, as well as maritime services which provides commercial technical asset management to our ships. Now, property, we invest property mainly in Japan and also outside of Japan. And outside of Japan, we mainly invest in Hong Kong. Now, in terms of FY 2022's financials, last year we actually achieved a record profit of 27.9 million US dollar. Okay, that's on the right of a very good shipping market. And we declared a dividend of 8 Singapore cents per share, comprising 3 Singapore cents per share of final dividend and 5 Singapore cents per share of special dividend. So if you were to acquire our shares now, you are still entitled to dividend. The payment date will be on the 31st of May 2023. Okay. So this dividend of 8 Singapore cents per share plus the interim dividend of 6.5 Singapore cents per share that we have already paid on the 30th September 2022. So for FY 2022, the total dividend per share that we paid out will be 14.5 Singapore cents per share. That will be the highest records in our group's history. Now, if you look at the history of our group, we have been paying dividend consistently of varying amount since FY 2012. So regardless of whether we are making losses or profits, we make it a point to pay dividend to our shareholders. And since 2019, FY 2019, we have been paying interim dividend with a stop only in FY 2020. But FY 2021, we continue to pay interim dividend, and last year we paid an interim dividend of 6.5 Singapore cents per share. So there are questions, of course, is whether this dividend payout is sustainable. To that, what we can say is that we try our best to make sure that we have profits. On the long runs, we have been around SGX main boards for 26 years and more and counting. I mean, we can't guarantee you whatever dividend amount that we are going to pay in coming years, but the final dividend amount, the interim dividend amount, is a good gauge of what we intend to pay shareholders. There's no point in us trying to promise a certain level of dividends, only not to be around for the next couple of years. So our first priority really, of course, is to be around for many, many more years to come. And therefore, when we manage our capital, we take that into account when we declare our dividend. So balance sheet wise, we have been paying down our debts. As you can see, our current assets as at the end of last year is more than our current liabilities. Debt equity ratio is less than 1. Okay, and if you look at our cash balances, as at end of last year, we have 47.1 million US dollar of cash, operating cash flow of close to 35 million US dollar. So in terms of borrowings, as you can see, our total borrowings have been reducing, and total finance cost is also manageable. Okay, so most of our borrowings are actually collateralized by our assets, in terms such as vessels and properties, and the value of the value of the assets are actually more than the amount of borrowings that we have. So there's no problems with us repaying our borrowings, and we have been consistently paring down our borrowings. Therefore, in terms of increase in interest rate in the coming months, is not going to have a significant impact on our P&L. Next, I will go on to Baltic Handysize Index. So basically for Uni-Asia, we own 10 wholly owned vessels of small handysize dry bulk carriers. And for the dry bulk markets, if you look at the supply and demand chart, the demand for dry bulks, they're mainly dry commodities, your grains, your dry goods, is expected to grow by 2% for 2023 and 2.2% for 2024. But in terms of the supply of vessels into the markets, especially small handysize, is expected to be a negative 0.2% for 2023 and a negative 1.7% for 2024. So this is based on the Clarkson's research published in January 2023. On the 26th of May 2023, this coming month, we will be announcing our first Q corporate updates, and in which case we'll update this chart. But as a whole, as you can see, the supply of dry bulk carriers into the market is expected to be much lower than the demand that is going to be coming into the markets. So therefore, in general, the market consensus is that the shipping market, notwithstanding that the dry bulk handysize index has come down, is expected to recover or stabilize or even be much better. It's going to be much better than the first half of 2023 for second half of 2023 and beyond. And if you look at our average charter, yes, it has come down for 4Q 2022 because the dry bulk handysize index has come down. But overall, for last year, it has been much better than that for 2021 and 2020. Okay, so what will it be for the second half of 2023? Of course, that's anybody's guess. First quarter of 2023, the index, of course, has come down. Our average charter has come down. Second quarter of 2023, there's still a question mark. Okay, so in general, when we manage our vessels, okay, we will carefully manage the charter of our vessels for short-term charter, that means shorter-term charter and longer-term charter. So basically, we own 10 wholly owned vessels. There are questions, how different are we from other shipping line? We own the vessels and we time charter them out to charterer. In other words, we don't take goods from clients to ship, but we lease out our vessels to shipping line for them to take goods to ship to their clients. So when we time charter them out, we also provide the crew for the ships. The fuel for running the vessels are the responsibilities of the charterer, that means our clients. So when we time charter them out to our client, we charter them out over a period, say half year to 1 year to even more than 1 year, depending on our expectation of the charter rates in the coming months. So for example, if we expect the charter rates for the second half to be higher, we can charter our vessels at a shorter period so that once it comes to the second half of this year, the charter period will fall off and then we can recharter them at a higher rate. So we have a dedicated commercial management team in Hong Kong looking at the market, talking to charterers, and to manage our vessels so that we can get the best charter rates for our 10 wholly owned vessels. So in this sense, our charter income will not be directly impacted for any short-term movement, okay, because we could have fixed the charter for a longer period. Of course, that will also mean that if we were to fix the charter rate at a much lower rate than the market, even though the market has gone up, we will not be able to enjoy. So therefore, it is actually dependent very much on our expertise, our team's expertise, in order to make sure that we can ride the wave up when the market is going up. Everybody knows that in the past 2 years, the shipping market has been doing well. We have recorded a record profit, but not all shipping companies or not all ship owners were able to enjoy such good markets. We all know that before the COVID-19, there are many shipping companies having problems. Many companies owning vessels have a lot of problems, and some of them have even collapsed. But we were able to survive because we not only have vessels, we also have property investments. And because our charter period came off before, many of the vessels came off, the charter came off before the COVID-19 period, we were able to fix at a much higher rate when the market picked up. So these are our strengths, these are our expertise, and this is what makes us different from other ship owners and shipping companies. Now, these are the 10 wholly owned vessels that we have. 5 of them are, as you can see, the capacity are 29,000 deadweight tons, and 5 of them are 38,000 deadweight tons. So small handysize dry bulk carriers are basically within this deadweight ton range. Dry bulk carriers basically carries your dry goods, your grains, your coal, your logs, your commodities, and is very closely linked to the commodity prices. Other types of vessels includes tanker, which we do not invest in. Tankers will basically carry your fuel, your oil, your liquids, your gas, and so forth. And for tankers, they will require more specialized crew to operate them to reduce the chance of accidents. So we do not invest or have any management of such vessels. The other type will be container vessels. So container vessels, as we all know, takes container goods, and container basically carries all the finished goods or semi-finished goods in container form. And we also do not invest in those vessels. So our specialization are in dry bulk carriers, especially the small handy size. So as you can see of this fleet of our vessels, 5 of them are actually relatively old. Going forward, I think one of the priority for us is to see how we can renew this fleet of vessels, especially those smaller and the older vessels. And this is what we have been thinking of and looking at for the sustainability of the business going forward. Next, I will move on to our property business. Other than shipping, we also have properties. In particular, for our investment outside of Japan, we invest in Hong Kong property development projects. And this includes office and industrial building development. We have a partner in Hong Kong and we take a minority stake in the consortium in developing these projects. So prior to the COVID-19, Hong Kong property project investment actually gives us very, very good returns and have actually helped to lift up the group's profits and sustain our dividend for the years prior to COVID-19. And this is why, although the shipping market was down, okay, we have a different business segment that can supplement our income, and we were able to enjoy the good shipping market when the turn comes. So each market actually have a different cycle and they are not correlated. Hong Kong market, unfortunately, as we all know, because of COVID-19, Hong Kong borders were closed. The Hong Kong property market was slow for the past 2 years. And actually right now, there are many people who investors actually ask us, why are we still investing in Hong Kong and so forth. They are the very same voice who actually asked us to dispose of our vessels prior to COVID-19. So we do take all these investments very seriously. We look at them in very detail, and our Hong Kong property could potentially help to contribute to our group's returns in the coming 2 years once the border open up, once the market picked up. So these are the potential contribution to our income in the coming years, the Hong Kong property projects. Next, we'll talk about our property investment in Japan. In Japan, we have a subsidiary, Uni-Asia Capital Japan, which has a property asset management license. Not many companies in Japan has a property asset management license. We are one of them. And one of the projects that we specialize in our ALERO projects. So for our ALERO projects, we purchase land, such as this, if you see in the picture, in Tokyo itself. And we typically look for properties that's near to train station and amenities. Thereafter, we tear them down, redevelop them into 4-5-story walk-up apartments of mansionette type flats. So each unit is mainly for professionals, one-person stay. And thereafter, the completed projects are leased out before they are being sold off en bloc. Now, such projects are actually of 20-30 units being leased out to professionals. Although Japan has a declining birth rate, but there are many professionals from other parts of Japan coming to Tokyo to work, and they actually like our design. If you look at the picture, our property, ALERO properties are very modern design, are very comfortable. So if you look at the surrounding of our ALERO project, actually they are very appealing to the young professionals from other part of Japan coming to Tokyo to work. So you can see from this chart, as at end of last year, we have 12 ongoing projects. We have 9 new projects for 2022 and 12 ongoing at the end of the year. So these 12 ongoing projects will then contribute to the profit, the bottom line of the group for 2023 and possibly beyond. So typically for our ALERO projects, we take 1, maximum 2 years from the whole exercise, from purchase of land to the disposal of the whole properties. We only hold maybe 2-3 projects for rentals, but otherwise most of them after completion we will dispose them for capital returns. In addition to our ALERO projects, our Uni-Asia Capital Japan also help our clients manage properties including hostels, hotels, healthcare, medical facilities, and the total asset under management has increased up to 37 billion Japanese yen at the end of 2022. So this asset management business also help to contribute to recurring charter income base. So for our group, other than shipping business, other than shipping charter income, We also have structured finance arrangement fee, asset management fees, income from shipping, from properties, capital returns from properties, and so forth. So this multi-layer income base will ensure that regardless of which sector that is suffering a downturn, the other sector could help to sustain our profit bottom line, so that ultimately we are able to sustain a dividend for our shareholder. These are some of the awards that we have received for last year. Last year, we were awarded silver for Best Investor Relations small category for Singapore Corporate Awards, and also for SIAS Investor Choice Award, Most Transparent Company. Thank you, SIAS. And also our Uni-Asia Holdings subsidiary has the 2021-2022 Good MPF Employer Award last year. So basically, that's all I have to present. This is a shortened version of the presentation slide that we normally announced together with our results. Yeah. Back to you, Eileen.
Thank you, Kai Ching. Let's come to the Q&A session. Before that, let me introduce my moderator, Mr. Benjamin Goh, Head of Research and Investor Educations. For those participating, you may key in your questions in the Q&A box, and we'll try to answer the questions as many as possible. Over to you guys.
Thank you very much, Eileen. Big thanks to Kai Ching. Very grateful for you to join us. We don't actually get to see your company, Uni-Asia, that much, so always a treat when you get onto our show. So thanks for being here. I think the only thing better than you being here is, of course, you buying us lunch during the presentation. But okay, we do have a couple of pre-submitted questions, so we're going to get through those, and we do have questions coming in from the Q&A function. So first up is you have presented quite a fair bit about the performance of Uni-Asia. So the question here is, what is the business vision for the company for Singapore as well as the Southeast Asia region?
So basically, our business is, for shipping is global. We charter our vessels to charterer basically all over the world, so long as they are credible. So for a time charter, as I mentioned during my presentation, we time chartered them, as the name implies, for a period of time. It could be 6 months, it could be 1 year, it could be more than 1 year. And for when we do time charter, it is very much like your rental income. You pay upfront, the client pay upfront, right? So the charterer will pay upfront. If they can't pay, then we'll take back the ships. So it's as simple as that. So whether or not the global recession coming, or whatever impact, goods need to be shipped, right? And commodities, your grains, your logs, and all that need to be shipped. And one of the main player in terms of commodity purchase, as we all know, is China. And for the second half of last year, one of the reasons why the index went down is because China has closed up because of COVID-19. But good news, everybody knows China has opened up, right? And the commodity demand is there from China. And we all know that they have manned the ties with Australia as well. So that could potentially, increase the demand for dry bulk ton miles on the sea as well. US itself, they also realize that they are lagging behind in terms of commodities, in terms of infrastructure building. And we all know that, before all this talk about wars and so forth, US has also approved a bill to actually build up the infrastructure. They will need all the steel, they will need all the concrete and so forth. And that may also contribute to the demand for the dry bulk ton mileage. Of course, Ukraine war, there are other macroeconomic factors that could also potentially impact. So to answer the question in short, I think for shipping wise, it's a global business. It's not just focusing on Southeast Asia. It's not just focusing on Singapore. So in that aspect, we are one of the few, I would say, companies that have global exposure. Property wise, of course, Hong Kong, it depends on the China markets. Japan depends on the Japan economy, but we all know that Japan property is very robust. Japanese yen is weak. Many investors want to invest in Japan, especially properties. We have many clients, especially Singapore high net worth individuals, working with us to invest in Japan. So that's also one of our strengths. We are able to bring foreign investors to invest in Japan Because if you were to invest in Japan, for example, you need somebody who is familiar there, know the language, know the culture, know the rules. You can look for us. And there are many smart investors. We know we have been doing IR for so many years. Unfortunately, we don't get to go to SIAS Connect a lot, but we do try and make an effort to go to very different avenues. And this year we have changed a new IR company, Gemcom. Hopefully with that, we can, some of the questions will be, we have deep discount in the NAV. We don't consciously try to do something like corporate actions which we don't believe in, but we do try to make sure that our business will be sustainable. No point if I tell you that I'm going to pay you an 8% dividend perpetually, only not to survive, right? So we are trying to do our business, we are trying to do our IR, we try to reach out as much as we can so that our visibility is there. And if you want to do business with us, you are interested in investing in Japan, you want to do some business in Hong Kong with us, we are open for business. You can always contact us. Yeah.
Okay. A related question that came in through the Q&A function is that one of the investors has noted that similar dry bulk companies have reported rather weak earnings on a year-on-year basis in the first quarter. So the question is, what about Uni-Asia's earnings? Do you think Uni-Asia's earnings will be in line with the overall dry bulk sector, or do you think it will be outperform or a little bit under?
On the whole, of course, for the dry bulk market, as I already pointed out, first Q is definitely weak. But when we time charter them out, some of our vessels are actually on a longer charter, which was on a higher charter rate. So we do have a mixture of that. On top of that, we are not just solely dependent on our shipping business. This is what makes us different from other shipping companies, which I also mentioned during my presentation. We all know, okay, if you look at the SDI index, 45%, right? As Jeff says, it's banking, How many of these are actually shipping? MPA is working so hard. 2 weeks ago, we have this maritime week. MPA is working so hard to bring shipping companies into Singapore, shipping business into Singapore. We all know that Singapore is a very important shipping hub, right? We're trying to build up that state. How many shipping companies are listed in Singapore? How many companies are actually related to shipping? Actually, it's very sad, right? So although we have shipping, there are not many shipping companies left in Singapore. So we are one of the few, because we have other business segments as well, because we have property investments. So that will actually complement each other. Of course, there are investors who say, hey, it's very hard to understand your business. You have shipping. I'm a shipping person. I don't understand your property. Same thing, the property people say, hey, I like to look at REITs because, I don't know anything about shipping. But exactly because we have all this mixture, which makes us more interesting than other companies that only focuses on one business segment. And because many people don't understand, that's why we work doubly hard for our IR. And because many people don't understand, that's why our share price do not reflect our real value. So for those who say, hey, your share price is low, it doesn't reflect your value, do you want to buy shares that already fully reflect their value? How much more can they go up, right? So we are doing all we can. We are trying to make sure that all our business segment, all the fire can go up. We have a strong balance sheet, and the next stage of growth really is to look for suitable assets to churn the next phase of growth for the group. And we are now in a very good position. We all know, with some more recession coming, maybe it's coming, maybe it's not coming. If you have the cash, if you have the financial power, then you can look for very suitable opportunities so that these assets can be acquired. And we are in such a good position right now. And this is something that many people do not know. Yeah.
Okay. There is a question here about the market value or the mark-to-market value of your dry bulk portfolio. I'm not sure whether you have that number or whether you are able to share that.
Yeah, so if you look at I think if you look at our financials, I'm not going to go to the details. Our 10 wholly owned vessels are held as fixed assets, okay, or what they call property, plant, and equipment on our balance sheets. So the net book value of these assets are shown in the notes to our audited financial statements. And for any fixed assets, as we all know, we have to look at the current market value or the value in use to compare whether the value is lower than our net book value. Okay, and if it's lower, we have to do certain form of impairment. The good news is for the past several years when the shipping market was bad, we have already taken whatever impairment that we have taken. Of course, our auditors for the past few years, because of the good shipping market, has been trying to influence us to try to write back some of these impairment. But of course, I think our net book value on our books actually reflects the actual value or a good value of our vessels. Are they going to be likely any further impairment? I think at this point in time, we don't think so, because if there were any impairment to be taken, we would have taken last year. Yeah.
Okay. And again, just to clarify, since you're talking about balance sheet, the net book value of your dry bulk, your ships, right, is also subject to the annual depreciation and other regular accounting rules,
Yes.
So which means that regardless of the state of the assets, you will always be going down. So I just want to remind the viewers of this call is that the balance sheet number is not totally representative of the health or the efficacy of the asset, because there's an accounting treatment to it. So don't just think that that is the real market value.
That's correct. Yep.
All right. Okay, good. There is a question about, yes, competitive advantage. So the person on this call wants to know what is the competitive advantage that Uni-Asia has in the dry bulk shipping sector.
Yeah, so I think I touched on that. I think we should not just look at our business on a standalone dry bulk or our ship property. So we should look at Uni-Asia as a group. But let's say if we were to focus on dry bulk, we focus on small handy size. Okay, small handy size, especially small handy size right now, the supply is really low, because for the past few years, container shipping line, as we all know, has been doing very well. You see on the newspaper, Evergreen paying out humongous bonuses to their staff. So a lot of the shipyards are actually have orders for huge container ships. They have no slots for smaller size vessels. So we are not expecting a huge inflow. That's why if you see my slides, it's actually a negative growth for small handy size. The supply is low, the supply is going to be negative. And to add to that, many ship owners do not know the kind of specs for dry bulk carriers going forward. What kind of fuel that should we use? Should you use methane? Should you use methanol? There's all this talk about the kind of eco ships that's going to come to the market. So many ship owners are hesitant about placing new orders. So in that aspect, supply is going to be low. Demand, really, when China open up, or there's always a demand for commodities. So this supply and demand situation was very, very different from back when 2015, 2016, 2014, when the shipping market was very, very bad. At that time, the interest rate was very low. A lot of funds flow into the shipping markets, such as hedge fund, because they have access to very low interest rate, and people are just freely buying vessels, for whatever reasons. So the situation is very different now. Supply situation is very, very good. Once the demand picks up, we expect a very stable dry bulk market. So our strength is that we have a very small fleets. We are very nimble. We can always buy new ships or switch to some other vessels. We can always sell our vessels. So in that sense, we are very nimble. We are not bogged down by any requirements or for dry bulk. So that's actually our strength in terms of our dry bulk market. Yeah.
Okay. All right. Thanks for that. A related question is, how is Uni-Asia's group different from Samudara Shipping?
Yeah, I think I also touched on that during my presentation. So that was the question, because Samudara is actually mainly a shipping line. They take the goods from their clients and they ship out. So obviously, they will have a more direct impact whenever the shipping market move up or down, because they will then be taking from the client itself. For ship owners like us, the impact is not so immediate. Our charter are fixed. So you can imagine, Samudara is like, your SBS, they are the bus line, right? And we are the asset owner who lease out our buses to SBS, for example, SBS Transit. Yeah.
Okay, that's a good analogy. So it's quite clear where the differences are. All right. Okay, let's move on to the dividend. So one of the favorite topics of SIAS viewers is dividend. A couple of questions here. So just to as a point of reference, and I'm just quickly pulling information that I've gathered. The 12 months, the historical 12 months or the trailing 12-month dividend yield for Uni-Asia was 11.39%. This is just a simple calculation. And the indicative yield for the next 12 months is 9.4%. So obviously, pretty good numbers, beats all the REITs out there, I think, not to mention the Singapore Savings Bond. So the question is this, do you think the dividend is going to be sustainable in subsequent years? Because it's pretty high. And also, would you say that Uni-Asia might consider changing the dividend frequency to 4 times a year? I think the last time you had that was back in 2019.
Okay, so dividend, I think the dividend sustainability matters. I also mentioned in my slides. You know, just let me repeat. Really, I mean, we don't want to forecast any form of dividend yield going forward or how much dividend we will pay. I think that's something that we don't do. And like I mentioned, if I were to tell you, I'm going to pay 8% perpetually, and then I'm going to die 2 years later, don't think that's something that you really want. So, well, what we can tell you is really, our focus really is on the bottom line. Our focus really is trying to find a different source of income to pound out our profit, so that we can have a very nice P&L, and that will be then the basis for which we can then pay out more dividend to our shareholders. And when we can, we will, and that's demonstrated by FY 2022. I think when we can, we have our balance sheets has been strengthened. Then we will want to pay off more dividend to our shareholders. And of course, one of the important things for small companies like us is we have to strengthen our balance sheets. We have to be very strong, so that we can weather any kind of storm that come our way. That's why we try to build up a strong cash flow. We try to pare down our borrowings. We can now say that our balance sheet is relatively strong, and we can take advantage of any new opportunities that may come our way. We can actually we are very nimble. We can actually buy a land in Japan, and then just dispose it 1 or 2 years later. Not many companies can do that. We can take advantage of any of such opportunities that's available. We don't have to be restricted by one particular mode of operations. Even for very opportunistic kind of investments, we can also make them. So this is one of our strengths. In terms of dividend, we have been paying twice a year, interim and final. We have never paid 4 times a year. That's because we do not announce first quarter results after SGX rules changed. For any dividend, it has to be accompanied with financial results. So we do not do quarterly results, and so therefore we will stick to twice a year, provided, of course, our profit enable us to do that. And in order to ensure that, of course, I mentioned many times, we try to have a multi-layer of profit. Yep.
Okay. All right. There is a question here about a dividend reinvestment plan. Okay, I think this is I guess what the investor is trying to ask, because obviously a company doesn't have a dividend reinvestment plan. I guess what the investor is trying to ask is, what are your plans for, putting back the extra cash flow, the free cash flow you have into the business so that you can grow it, right? So instead of giving the cash flow out as dividends, you got cash flow. So what are your plans on how do you intend to reuse the free cash flow to grow your business?
So back to the same thing, when we build the cash, when we make investments, right? I think anybody knows when you make investments, the timing is very important. You don't rush to get into investment. You don't rush to buy vessels when the price is high. Now the shipping market, the past 2 years, shipping market was very good. Vessel prices were very high. Actually, those were the good times to sell, right? And when the properties prices were low, actually those were the good times to buy. But when the opportunity comes, do you have the cash? Do you have the financial assets? So what we can tell shareholders is that we don't rush to get into the investment, right? But meanwhile, we make sure that whatever assets that we have can generate enough profit to pay off dividend to shareholders. But we will try to make sure that we have the financial muscles to take advantage of any good opportunity. So that's actually the very good balance, a very important balance that we need to take care of. And this is why we have all the multi-prong of assets and multi-layer of profit, So that on the one hand, we have enough financial muscles to go and buy whatever assets. On the other hand, we have recurring income to pay off dividend.
Okay. Well, sounds a very robust, sensible fiscal plan. Okay, I'm just again related to a different question, just checking the financial ratios. So on a price to book, price to sales basis, Uni-Asia appears to be deeply undervalued. Okay, so the question here is: does a company is a company considering any kind of corporate action, for example, a stock repurchase plan, to bring the price back more in line to its intrinsic value of the company?
Yeah, so for any corporate actions, right? In my opinion, in our opinion, management's opinion, is a very, very short term. It's not a long-term solution. The long-term solution is really go back to the basics, grow the business, grow the net asset value, make profits, do our IR. I think those are the hard work that we need to do, and we are doing it, right? Now, if you look at share buyback, I mean, if you look at earnings per share, I mean, many people talk about share buyback, right? If you look at earnings per share basically is earnings divided by number of shares, right? Which is easier to increase EPS? Is it easier to increase earning, or is it easier to reduce the shares? Of course, I can just give a call to my broker. I can buy back our shares. We can reduce the shares next week. That's the easiest way to increase the EPS, right? And suddenly our EPS increase. But increasing earnings, that's the difficult part. And shareholders should not reward companies who do share buyback, right? I mean, really, you're rewarding them to do a shortcut method of increasing EPS. That's why from our last AGM, we have actually scrapped the share buyback mandate that we're going to seek from shareholders. So we don't believe that all these corporate actions, these are all very short term. We believe in the longer term. That's why we have been around since, we were founded in 1997. We have been around for 26 years. We were listed on SGX 2007. We listed for 16 years. We want to continue to be around for many, many more years to come. Okay, so we want to make sure that these are very hardworking, consistent approach, going back to the basics, so that we have profit to reward to shareholders.
Yeah. Okay. So just to add on, it is empirically correct to say that a one-time share buyback is a drop in the ocean. So if you look at companies like Disney or JP Morgan, they do share buybacks all the time. If they don't do that, the stock price will suffer. So it's not like Uni-Asia does it this quarter and then forget it. No, cannot. So I guess, again, it comes back to the fiscal soundness of the business model and the balance sheet. So, from a long-term investor perspective, my opinion is that employ back into the business. But anyway, your opinion might differ. Okay, so great. Now let's move on in the next few minutes. Risk factors, right? So you talked about the economic situation buffeting the global trade links as well as Asia in general. Is there any specific risk factor or any risk factor specific to Uni-Asia that you want to point out and perhaps discuss?
Yeah, I think our risk factors, of course, there are many. We are, like any other companies, exposed to all the macroeconomic factors. How the relationship between US, China is going to pan out. Would that have any impact on the shipping market? Would that have any impact on our Hong Kong property? How would the fund flows then into Japan properties? Would that then present us other opportunities to invest outside of Hong Kong and Japan, perhaps in Singapore or any part of the world? So these are some of the risks and possibly opportunities that we always assess, macroeconomic factors, interest rate factors, just like any other companies. So I can't pinpoint one specific. We do our enterprise risk management every quarter. Look at them and look at all the risks that we assess. Yeah.
Okay. All right. So thank you very much. There was another question about dividend, but I think you've already answered that one. So
I can't tell you any much more about dividend, as much as I would like to, but
So, all right. I think what we can do is that we have Uni-Asia join us on a more regular basis. So at least the
yes, please.
would get better updates and guidance on the dividend. Right. So hear you, absolutely reasonable. Not to have a hard-coded dividend policy. All right. So with that, I want to thank you for your participation. I'm going to hand the time over to Eileen.
Thank you for insightful Q&A sessions, and of course, Kai Ching for giving us some colors to your FY 2022. We hope that everyone enjoyed today's session. If you have any additional questions or you would like to continue the discussion, please feel free to connect with us. And also, of course, like what Ben says, we welcome Uni-Asia to join us more frequently for our Corporate Connects and other SIAS event. And then for participants, in case you miss any of today's session, you can rewatch the webinar on SIAS YouTube channel. And of course, Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on our upcoming investor education program and initiative. The upcoming Corporate Connect will be next week, featuring 10 United Corporations on the 16th of May. Once again, thank you for joining us today and have a good lunch. Thanks, everyone.
Thank you very much, Kai Ching. It was a pleasure speaking to you.
Bye.
Bye.
Bye.